Welcome to the deep dive. Today we're tackling something pretty interesting. How can commercial real estate actually make money, even when it's, not fully occupied?
Right. It seems counterintuitive, doesn't it? You see an empty building and assume it's just losing money.
Exactly. We've all seen those vacant storefronts or offices, but the idea that they could still be generating income, that's what we're digging into.
And we've looked at quite a bit of material on this. There are actually several concrete strategies people are using. It's not just theory.
Yeah, our sources cover a lot, from sort of the basics like long-term leases all the way to things like REACH, real estate investment trusts, and crowdfunding, which feels newer.
Definitely.
So for everyone listening, our mission today is really to unpack these different ways property can generate passive income, even if there isn't a traditional tenant paying rent right now.
Kind of challenges that old model, the one where occupancy is the only thing that equals income.
It really does. The landscape seems much more adaptable now.
Yeah, the sources show income can be, well, decoupled, at least partly, from that direct tenant relationship.
Okay, so let's get down to brass tacks then. We're using this term passive income. In the world of commercial real estate, what are we actually talking about? How do our sources define it beyond just collecting the rent?
Well, at its core, passive income means earning money without, constant active day-to-day involvement. And yeah, traditionally in commercial real estate, that was basically rental income. You lease it out, you get checks.
Right.
Simple. But the materials we reviewed, they point to quite a few other avenues, ways to earn without being the hands-on manager.
Okay, so we definitely see the standard stuff in the sources, renting offices, locking in long leases for shops or warehouses. That's there.
The foundation.
But then it branches out, right, into things where the owner's role is much smaller, like putting money into REITs you mentioned, or those crowdfunding platforms.
That's a really key distinction. It's a spectrum of involvement. Even with a property manager for your own building, you're still the owner making big decisions. But investing in a REIT, your role changes completely. You're more like a shareholder.
Okay, REITs. Let's pause there. The sources frame them as a key passive income route. What exactly are they, and why are they so hands-off compared to owning the building yourself?
Okay, so think of a REIT as a company. Its main business is owning and usually operating properties that make money. Could be office buildings, malls, apartments, warehouses. One source even mentioned things like cell towers, data centers. Really diverse.
Oh, interesting.
And when you invest, you're buying shares in that company, just like buying stock.
Plus, many REITs are legally required to pay out a big chunk of their taxable income as dividends to shareholders.
So it's almost like buying a small piece of a big managed real estate portfolio.
Yeah.
Without the actual hassle of being a landlord, finding tenants, fixing leaks. Exactly. The REIT's management team handles all that operational stuff, your potential return. It comes mainly from those dividends. Plus, the share value itself can go up or down, like any stock, depending on the market and how well the REIT performs. And it's worth noting there are different kinds. Equity REITs own the actual buildings. Mortgage REITs, they invest in mortgages. Different risk, different reward.
That's a good point. And the sources mentioned other benefits too, didn't they, besides being hands-off and getting dividends?
Yeah, liquidity is a big one. One article really highlighted that. Unlike selling an actual building, which can take ages.
Oh, yeah?
Shares in publicly traded REITs, you can usually buy and sell them pretty easily on stock exchanges. That accessibility is a major draw for some investors.
Makes sense. Okay, shifting gears a bit. Crowdfunding. That came up a lot too. Feels quite different from REITs. How does that work for passive income in commercial property?
Yeah, it is different. Crowdfunding platforms essentially let a bunch of people pool their money, often smaller individual amounts, to invest in a bigger project. Think like financing a new development or buying a larger property together, things that might be too pricey for one person alone.
So instead of needing, say, $1 million for a down payment on a shopping center, I could maybe put in $5,000 alongside hundreds of others.
Precisely. The sources point out this dramatically lowers the barrier to entry. You don't need huge capital to get a piece of potentially income-generating commercial real estate.
Right.
And it lets you diversify, too. You could put smaller amounts into several different projects, different types of property, different places, spreads the risk.
Without having to manage any of them directly?
Correct. But there's a but. Doing your homework, the due diligence, can be harder for individual investors on these platforms and these investments. Often less liquid than REITs. Harder to get your money out quickly if you need it.
Okay. And one source actually named a platform, Fundrise. Are they all pretty similar, these platforms?
The core idea is usually the same, yeah. They connect developers needing cash with investors looking for real estate opportunities. But the details, they can vary quite a bit. The types of deals they offer, the fees they charge, how much vetting they do up front. You really need to look into the specific platform. They manage the investment for the crowd.
Got it. Okay, so those are the more indirect routes, REITs, crowdfunding. What if you already own a commercial property? How do you optimize that for passive income, especially thinking about, potential vacancies?
Ah, now that's where strategy comes in. Even if the goal is passive income, you still need to make smart, proactive choices about the property itself. Several sources hit on this.
Like what? Long-term leases kept coming up.
Absolutely. That's kind of the bedrock for passive income from direct ownership. Stability. A tenant locked in for years means predictable cash flow. And ideally, you structure it as a net lease.
A triple N thing, NNN.
Exactly. Where the tenant pays for property taxes, insurance, maintenance. That shifts a lot of the costs and hassle away from the landlord, making it much more passive.
Makes sense. Less turnover, predictable money, fewer surprise bills. Now, what about diversification within your own properties? One source mentioned owning different types of commercial space.
Yeah, that's a risk mitigation strategy. Think about it if you only own retail spaces and retail takes a hit.
You're in trouble.
Right. But if you also own some industrial space or maybe an office building and those sectors are doing okay, their income can help buffer the losses from the retail side. It smooths out your overall income stream.
And I'm guessing the old mantra still holds. Location, location, location.
Oh, absolutely. Can't emphasize that enough. The sources are unanimous. Picking the right area, strong economy, high demand, good growth prospects, that's crucial. It makes finding and keeping good tenants so much easier, which means fewer vacancies in the first place.
Okay, but even with a great tenant in a great spot, isn't there still a lot of management involved? How does hiring a property manager fit the passive income goal?
Well, that's often the key step to making it truly passive. A good property management company takes over the day-to-day grind. They handle tenant screening, collecting rent, dealing with maintenance calls, making sure you're following all the rules and regs.
So they do the active work.
Pretty much. You pay them a fee, of course, but they free up your time and energy. It's an investment in becoming a more hands-off owner. You'd want to track things like how well they keep the place occupied, tenant satisfaction, make sure they're doing a good job.
Okay, that makes sense. It's a cost, but maybe worth it for the passivity. Now, what about renovations? One source mentioned improving property value. How does that help passive income, especially if the place is empty now?
Yeah, that might seem active up front, and it is an investment, but think long term. Upgrading a property, it makes it more attractive. You can potentially charge higher rent, attract better quality tenants, maybe get them to sign longer leases.
Ah, I see. So it reduces future vacancy risk and boosts future income.
Exactly. So even doing renovations during a vacant period is really an investment in making the future income stream stronger and more reliable, more passive over time.
And being flexible with leases. That was another point raised. How does that work?
It's about being strategic. Maybe offering certain options, like giving a good tenant the first chance to rent adjacent space if it opens up. Or maybe, for some types of businesses, being open to slightly shorter terms initially to get them in the door.
Seems counterintuitive to the long-term lease idea, though.
A little, yeah. But sometimes that flexibility makes your property stand out, attracts more potential tenants, and ultimately helps keep occupancy high. High occupancy means more reliable income. It's a balance.
Okay, looking ahead, the sources mentioned a couple of areas that might be particularly good bets for stable passive income. Data centers and industrial properties. Why those specifically?
It comes down to demand, really. Think about how much we rely on technology, cloud computing, online shopping.
Right, it's huge.
That's driving massive ongoing demand for data centers, the buildings that house all the servers and equipment, and e-commerce. It needs warehouses, logistics centers, distribution hubs, that's the industrial sector. The underlying demand in these areas seems really strong and likely to continue growing. That suggests potentially more stable occupancy, fewer vacancies.
And therefore, more reliable passive income streams down the road.
That's the thinking, yeah. But, it's not a guarantee.
Of course.
You still absolutely need to do your homework on the specific market, the specific location, even within those sectors. Thorough research is key.
Which nicely brings us to the key takeaways, the must-dos for success. Market research came up again and again.
Absolutely critical. You have to understand the local dynamics. What are vacancy rates like now? What are typical rents? What's the demand? Is the local economy growing or shrinking? That knowledge informs everything, whether you're buying a building directly or picking a REIT focused on a certain area.
And getting expert advice also seemed important.
Highly recommended. Talk to financial advisors, experienced commercial real estate brokers who know income properties, lawyers. They can help you navigate the complexities, avoid pitfalls, make sure your strategy actually aligns with your goals and how much risk you're comfortable with.
And we keep circling back to location, especially for avoiding those vacancies.
It's worth repeating because it's fundamental for direct ownership. A good location in a thriving area is your best defense against sitting empty. It helps you get good tenants and keep them. That's the foundation of consistent passive income from property you own.
Okay, let's try and wrap this up for our listeners. The big takeaway seems to be that passive income from commercial real estate isn't just about rent anymore. There's a whole toolkit of strategies.
Exactly. You've got indirect routes like REITs or crowdfunding if you want to be more hands-off. Or you can optimize a property you own directly: long leases, diversification, good management, smart location choices, even focusing on growing sectors like industrial or data centers. And importantly, even if your own building hits a rough patch with vacancies, having some of those diversified indirect investments can still keep some income flowing.
Right. So maybe a good next step for anyone listening is to pick one of these ideas we've talked about: REITs, crowdfunding, optimizing an existing property, and just start researching it a bit more, see if it feels like a fit.
Yeah, absolutely. See what's out there.
And maybe a final thought to leave everyone with. Think about your commercial property, whether it's a building or just a stake in something bigger. Its potential might go way beyond just having a tenant inside.
Mm-hmm.
In today's market, what other ways could you unlock that potential? What could make your real estate investments more resilient, more passive? Definitely something worth mulling over.